Most of the passive income advice on the internet is actively dangerous. You click on a video promising freedom, and 10 minutes later, you are being sold a course on dropshipping or starting a marketing agency. Let's be very clear right now. Those are not passive income sources. Those are second jobs that you do on your phone while you are supposed to be sleeping. If you stop working, the money stops coming in. That is the definition of a job, not an asset. Today, we are fixing the definitions. We are ranking every major income stream, from real estate and dividends to YouTube and crypto, on a ruthless tier list based on two things: how hard it is to start and whether it actually pays you while you sleep, or just pays you while you stress. Before we throw the first asset on the board, you need to understand the scoring system. This matters because most people pick the wrong strategy for their personality type and burn out in 3 months. We are judging on two axes. First is the passivity score. This is the Coma Test. If I fell into a coma for 6 months, would this asset keep depositing money into my bank account, or would the business collapse? S tier passes the Coma Test. F tier fails it immediately. The second axis is the barrier to entry. This is the combination of capital, skill, and pain required to get the first dollar. Usually, there is a trade-off. Easy to start often means hard to maintain. Hard to buy often means easy to hold. The goal of this video is not just to rank them, but to show you the specific order of operations you should actually follow to escape the rat race. I'm going to save you about 5 years of trial and error in the next 30 minutes, which is a pretty good return on investment for your time. If that sounds like a fair trade, go ahead and subscribe to the channel. I break down the math of wealth without the hype every single week. Now, let's start at the bottom of the barrel, because we need to clear out the garbage before we can get to the gold. Let's start with the F tier, the category I call fake passive. The king of this category is dropshipping. You know the pitch. Set up a Shopify store, find a cheap supplier in China, run some ads, and act as the middleman. You never touch the product, you never hold inventory, and you just collect the spread between the wholesale price and your retail price. It sounds like the perfect digital asset. On paper, it looks like a money printing machine that requires zero capital. But the reality is that dropshipping is not investing. It is high-stress retail arbitrage in an incredibly crowded market. You are competing against thousands of other people selling the exact same vegetable chopper or galaxy projector, often using the exact same video ads. Here is the math that the gurus rarely show you on their dashboards. They show you revenue, not profit. Let's say you sell a product for $50 that costs you $20. That looks like a $30 profit. Amazing. But acquiring a customer on Meta or TikTok in 2025 is expensive. Your cost per acquisition might be $25. Now your profit is $5. Then you have payment processing fees, Shopify monthly fees, and the cost of returns. If one customer returns that item, you wipe out the profit of your last 5 sales. I have seen the back-end numbers of dozens of these stores. The net margins are razor thin, often around 10 to 15%, and that is only if you are managing the ads daily. If you stop tweaking your ad creative, your acquisition costs spikes, and you are losing money instantly. The psychological trap here is the low barrier to entry fallacy. Because it is easy to start, everyone starts it. That means the competition is brutal. You aren't building an asset, you are fighting a war. Every morning you wake up to check if your ad account got banned, if your supplier raised prices, or if a competitor stole your video. That is not passive income. That is a high-anxiety, low-margin job where you are glued to your phone. It fails the Coma Test within 48 hours. If you want to run an e-commerce business, go for it, but do not call it passive. Now, you might think dropshipping is the worst offender because of the workload. But there is another F-tier contender that demands zero work, but carries a 100% chance of ruining your year. It's the set and forget crypto yield farming schemes. If you think the risk in retail is high, wait until you see the math on 40,000% APY. To be clear, I am not talking about Bitcoin or Ethereum held in cold storage. I am talking about passive income protocols that promise you daily returns of 1% or massive annual yields for staking a token. Here is the math trap. If a protocol pays you in a token that is inflating by 100% a year to pay those rewards, the value of the token drops by 50%. You are getting more coins that are worth less money. It is a dilution machine. This is F tier not because it requires work, but because it is gambling masquerading as income. Real passive income comes from profit generation, selling goods, renting land, lending capital. These schemes come from Ponzinomics. Stay away unless you treat it strictly as a casino trip. Moving up to C tier. These are ideas that are genuinely passive, so they pass the Coma Test, but they are either too risky or too low return to be your main engine. First up, peer-to-peer lending. The idea is simple. You play the bank. You lend $500 to a guy named Steve so he can consolidate his credit card debt, and he pays you 10% interest. Platforms automate this, splitting your money across hundreds of Steves to lower the risk. It sounds great. Who doesn't want to earn double what the bank pays? The problem is the risk-adjusted return. In a good economy, you might make 7 or 8% after fees. But unlike a bank, your capital is not insured. If a recession hits and job losses spike, defaults rise. If your default rate hits 5 or 6%, your real return drops to 1 or 2%. You are taking on equity-like risk for bond-like returns. Plus, your money is illiquid. You can't just pull it out instantly if you need it. It's C tier because while it is passive, it's not an efficient place for serious capital. Also in C tier is the high-yield savings account and cashback stacking. This is the definition of passive. You put money in, you get 4 or 5% out. No risk, FDIC insured. But we have to be realistic. This isn't income. It's a shield against inflation. If inflation is 3% and you earn 5%, your real return is 2%. On $10,000, that is $200 of real purchasing power a year. It's fantastic for your emergency fund, but you will never retire on a savings account. It's infrastructure, not an engine. Now we cross the line into the assets that can actually make you rich. But there is a massive catch. The B tier contains the most powerful wealth creators on this list, but they are also the most misunderstood. People think they are buying an asset, but they are actually signing up for a career change. If you treat this next tier like a passive investment, it will fail. If you treat it like a startup, it can fund your entire life. B tier is the active business category. This includes YouTube channels, niche SEO blogs, and print-on-demand stores. Let's look at YouTube. I love YouTube. It pays for my groceries. But calling it passive is a joke, especially in the beginning. To get a channel off the ground, you need to learn scripting, lighting, audio, editing, thumbnail psychology, and analytics. It is a high-skill profession. You might work for a year and make $0. That is a barrier to entry that filters out 99% of people. However, unlike dropshipping, you are building a library. Here is why it hits B tier and not F tier. Once a video is published, it becomes a digital employee. I have videos from 2 years ago that still generate ad revenue and affiliate sales every single day. I don't touch them, they just work. If you build a library of 100 evergreen videos, you can stop uploading for a month and the check will still clear. That is semi-passive. But, and this is a big but, if you stop for 6 months, The algorithm forgets you. Your views degrade. You have to keep feeding the beast to maintain the momentum. It is a high-leverage business, but it requires your face, your voice, or your brain constantly. The same logic applies to niche websites and print on demand. You write the articles or design the t-shirts once, and they sell forever. Sounds S-tier, right? The catch is rank decay. Google updates its search algorithm and your traffic vanishes overnight. A copycat steals your t-shirt design and undercuts you by $2. To keep the income stable, you have to constantly defend your territory. You are the CEO of a media company. It's a great way to make high income, but don't fool yourself into thinking you can walk away forever. So B tier is great for generating cash, but it requires your time. Now we move to the A tier. These are the heavy hitters. These are assets you can buy that have immense power, but they come with what I call the friction tax. If you ignore this tax, a single bad month can wipe out 3 years of profit. Let's talk about the holy grail of the middle class: rental real estate. Direct real estate, buying a house and renting it out. This is A tier because it offers 4 wealth generators in one: cash flow, appreciation, loan paydown, and tax benefits. It is a powerful wealth multiplier. But is it passive? Absolutely not. Real estate is a hospitality business. You are providing a service, housing, to a customer, the tenant. Even with a property manager, you are the asset manager. You have to approve the new roof. You have to decide whether to evict the single mum who lost her job. You have to refinance the debt. Let's run the numbers that Zillow doesn't show you. You buy a place, and the mortgage is $1,500. You rent it for $2,000. You think you are making $500 a month. That is phantom cash flow. You haven't accounted for vacancy. If the property sits empty for 1 month a year, that costs you $2,000. Divided by 12, that's $166 a month gone. Repairs and maintenance average another 10%. Property management is 10%. Suddenly, your $500 profit is actually $50. One busted water heater puts you in the red for the year. It's A tier because over 20 years, the appreciation and loan paydown make you rich. But day to day, it is lumpy, stressful, and requires significant capital reserves. It passes the Coma Test only if you have a great team in place, but even then, it's semi-passive at best. The other A-tier contender is high-quality digital products: courses, apps, templates. This is different from the B-tier content grind because a product is a finished asset. If I write a comprehensive ebook on gardening or build a Notion template for project management, that asset is done. I can sell 10 copies or 10,000 copies, and my effort is the same. The marginal cost of replication is 0. This is the most scalable income on the list. If you have an automated funnel, ads driving traffic to a landing page, you can literally wake up to money. The barrier to entry is high skill. You have to make something actually good. But once it's built, it sits very close to S-tier passivity. We have covered the grinders, the businesses, and the friction-heavy assets. Now we arrive at the S-tier, the God tier. These are the only assets where laziness is actually a competitive advantage. The less you touch them, the better they perform. This is where you want to end up. And the first one is the most boring, unsexy strategy in the world, which is exactly why it works. S-tier asset number 1, broad market and dividend ETFs. This is the cleanest form of passive income in existence. You buy a fund like VTI, Total Market, or SCHD, Dividend Focus, and you instantly own a slice of thousands of companies. You don't manage the employees, you don't create the products, you don't deal with the customers. You just provide the capital, and the CEOs of Apple, Microsoft, and Home Depot go to work for you. They generate profits and they send you a check every quarter. It passes the Coma Test with flying colours. In fact, if you went into a coma for 10 years, you'd probably wake up richer than if you had been trading actively. So what's the catch? Why isn't everyone doing this? It's the barrier to entry. Not skill, it takes 5 minutes to set up. The barrier is capital. To make meaningful income, you need a lot of money. If a dividend fund yields 3%, you need $1 million invested to generate $30,000 a year. That is depressing for a beginner with $500. But remember the axes. We are judging on passivity. Once the money is in, the passivity is absolute. There is zero friction. This is the ultimate goal, to accumulate enough capital so that the 3% yield covers your living expenses. The second S-tier asset is REITs, Real Estate Investment Trusts. This is how you get the benefits of real estate without the 2 a.m. calls about the toilet. A REIT is a company that owns commercial properties, malls, data centers, warehouses, and by law, they have to pay out 90% of their taxable income to shareholders as dividends. You buy shares on the stock market just like Apple. You get the rent checks, but you are not the landlord. You are the shareholder. This is superior to buying a rental property for most people because it is liquid. You can sell your shares in seconds. You can't sell a bathroom in your rental house if you need quick cash. The yields on REITs are often higher than regular stocks, usually between 4 and 8%. They are fantastic for cash flow. The risk is that they are sensitive to interest rates. When rates go up, REITs can go down. But again, operationally, it is zero effort. You check your portfolio once or twice a year, you reinvest the dividends, you sleep. That is S-tier behaviour. So we have the tier list. Now, what do you do with it? Here is the meta strategy that wealthy people use. Most people try to jump straight to S-tier, realised they don't have enough capital, get discouraged, and fall for an F-tier scam. Don't do that. You need to view your financial life as a pipeline. In the beginning, you have energy but no money. You operate in the B tier. You start the YouTube channel. You build the side hustle. You grind on the active business. You use that high effort income not to buy a BMW, but to buy S-tier assets. You funnel the volatile active cash flow into boring, stable ETFs and REITs. Whenever you look at a new opportunity, ask yourself 2 questions. Number 1, is the bottleneck my time or my capital? If it requires your time, it's a job or a business. Treat it like one. If it requires capital, it's an investment. Number 2, if I stop today, when does the money stop? If the answer is instantly, it's F tier. If the answer is slowly over a year, it's B tier. If the answer is never, it's S tier. Your goal is to constantly move your effort from the first category to the last. True freedom isn't about finding a passive side hustle that pays you $50 a month. It's about building an active engine that generates enough surplus cash to buy your freedom through S-tier assets. It takes time. It's boring. It's not a get-rich-quick scheme. But it is the only path that actually works mathematically. Don't get distracted by the flash. Focus on the friction. I want to know where your current income streams sit on this list. Are you heavy on the B-tier grind, or are you stacking S-tier assets? Drop your current mix in the comments. I read through them to see what strategies are working for you guys in the current market. If you found this breakdown useful, hit the like button so the algorithm knows to share it with more people who are tired of the fake guru nonsense. Thanks for watching, and I'll see you in the next